everybody. Reporting to you again from the Glamour City, Hollywood.
Part of the challenge actually right now is they have raised so much capital, these infrastructure funds, that they're sitting on a lot of cash. And I actually think that's an opportunity for climate action because they're considering projects and investments that they may not have considered, a year ago, because the speed of deployment is still important. And you can't be sitting on $1 billion of cash if you're expecting to continue raising capital. And so that's actually, I think, a category of sort of good problems to have.
If you love listening to this show, please consider giving a rating and a review on Amazon Alexa or wherever you listen. We want to continue bringing you this amazing content, and part of our ability to do that means that we need a big audience. Now, it may not seem like much, but rating and reviewing the show will help more people find us, just like how you found this show. Simply on any podcast platform, search for a show, scroll down to the bottom, and push 5 stars. It's that easy. Thanks for supporting the show. Today, I'm joined by Kim Flynn, president at XA Investments. Welcome to the show today.
Thank you, Scott.
Well, first of all, congratulations are in order for your recent promotion to president at XA Investments.
Thanks, Scott. You're going to make me blush. No, I've been running the business for a long time, so it's always nice to have the title match the work being done.
Well, we're certainly going to get into that, and of course, what XAI does. But you've helped build out their proprietary closed-end fund platform, I believe, as well as really strengthen their consulting services, which we'll get into a little bit. But can you first tell us about your background and your experience around closed-end funds, ETFs, UITs, commodity pools, and other structured products, to name a few?
Absolutely. So I'm a Chicago-based person, and I spent the early part of my career at Morgan Stanley and at Nuveen Investments. And Nuveen is a leader in closed-end funds, primarily because of their municipal bond heritage. But the closed-end fund structure it's a registered 40 Act structure that same as a mutual fund, but it's now being used to house private market strategies and capabilities. And so there's just been an explosion of interest in the space. And that was what led me to found XA Investments 8 years ago. And we work with a lot of different alternative investment managers across an array of alternative investment capabilities, helping them design the right kind of products for individual investors.
Right. I know that you've somewhat explained a little bit around some of these products, but maybe a little bit more in layperson's terms for the listeners. How would you explain some of these structured products, and specifically, how does it tie into climate action?
Absolutely. So, in terms of being able to access private market investments, many individual retirees did not have access. You can buy stocks and bonds in mutual fund or ETF format. And so, we've long benefited from real estate, private equity, venture capital in the form of pension capital pools or endowments. But having those types of private market capabilities be available and open for individual investors is really something that's been made possible in the last few years. And so why is that important? Well, if you're saving for retirement and you want the opportunity to earn higher returns, being able to access companies at a private stage before they go public, either via private equity or venture capital, most individual investors are left out of that massive growth that happens. And the same is true for private companies in the infrastructure category or in technology that have some beneficial impact. And so we're seeing now products that with that goal in mind, either sustainability or having an express impact, being developed and launched. So investors who want to make attractive levels of returns, but also care about how they're allocating their capital and would like to see that capital deployed in an area where they're aligned in terms of their interest. We're actually seeing a lot of impact funds, sustainable infrastructure funds coming to market that allow investors to express that view in the private markets. And they have a lot of choice in the mutual fund space, but not so much in the private market space.
Yeah, what you're saying is actually really important for a number of reasons. So first of all, typically for private markets, you have to be an accredited investor that has different definitions and thresholds. And again, if you're a mainstream average retail investor, you're just not going to have access to that because you don't qualify. But more importantly, when we think about new forms of technologies that are going to be making an impact around climate action, sustainability, a lot of these are going to be fairly new burgeoning companies. By definition, they probably are going to be mostly still private and still up and coming, whether they're trying to resolve carbon sequestration, whether it's around sustainable agriculture, for example, a number of things. So while there are some public opportunities, it's fairly limited. So it certainly makes a lot of sense that they can start to apply resources where they actually care in terms of their philosophy, their principles, and values. Now, uh, can you talk about kind of the regulatory environment in terms of how friendly this new set of categories, structured product categories, has been? And are there specific, maybe sub verticals that have become more popular than others?
Yes. So I would say that this SEC in particular is concerned with protecting individual investors. And so unfortunately, that means protecting investors from what they would perceive as higher potential risk. And so I would say that while the SEC would like investors to have more options, they're very careful with respect to there's a lot of areas that and alternative investment markets include things like crypto and others, that those sorts of areas concern the SEC more than, let's say, infrastructure, for example. And so the product structures, they fit within the regulatory environment. And frankly, the SEC would rather see private markets exposures in the structures that are built for purpose, as opposed to, for example, having mutual funds be more heavily allocated to illiquid investments, because it's at odds with the mission of a mutual fund, which is to have daily ins and outs and provide liquidity. So in some sense, the SEC is saying the mutual funds should be as liquid as possible, and there have been rules imposed around liquidity constraints and not allowing mutual funds to, for example, to invest as much in private companies, perhaps as they were a few years ago. There's more limits on that. And so these 40 Act interval fund structures could have 100% invested in private markets assets that are illiquid. And that's because the structure itself is designed for that. So I would say that in that sense, the SEC wants people to build products and disclose the risks of investing in those products in an appropriate way. And so there's still a lot of education that needs to happen, because if you've been historically investing in, large cap equity, and now you're contemplating a venture investment, manager skill, for example, is very important when you're investing in private equity and venture capital. But that's where a lot of growth is happening for US companies. And so, our belief is that individual investors should have access. And obviously, there should be appropriate disclosures as to what they're getting into. And so yeah, there's a lot of education that has to go around these products because of the regulatory environment that we're in.
And I think you've addressed it in a very diplomatic way in terms of retail protection, and certainly around crypto, it's been quite loud, to say the least, in terms of, SEC recognizing Bitcoin as a commodity, but everything else like Ethereum and even exchanges with lawsuits and treating other things as securities, for example, has been really oriented towards protecting investors for good reason, certainly. And a lot of the altcoins have been very problematic and very risky. But when we talk about infrastructure projects, these are very important things. Again, for us to make any kind of dent around climate action, we need to do some large scale things. So we have both natural but passive and active, including engineer solutions around carbon sequestration. These are very large footprint, very capital intensive things that really needs the support of institutional investors as well as an involvement and activity of the retail investors. Now, you brought up an excellent point, which is around the investors' understanding of the managers. Now, and I'm just going to say it because it's a fact, is that if you look at PitchBook, and I think the numbers just keep going up, I believe I'm kind of losing track of the number of startups that have failed. It's significant, significant.
Mm-hmm.
And it's not necessarily that those individual startups were bad, but I think they got caught up in the times where the last 3 years has been really the dot-com bubble, to say the least. I mean, you can make that argument about the general stock market, but they effectively imploded when there wasn't enough, true fundamentals to support those theses. Now we're at a point where we're not really sure which ones are going to still be around. And given the uncertainty around inflation, given the uncertainty around some of the regional conflict as we speak, it's challenging time. So how should retail investors and certainly the alternative asset managers think about vetting out the PEs and the VCs?
Yeah, absolutely. And a lot of these new products have very limited track records. And so you really do have to look to the manager themselves and undergo a diligence process where you're evaluating the firm and potentially, the private fund track record, which goes back much further than these public registered funds. I think that some of the gatekeepers, even with that, are waiting and seeing a little bit, giving the funds themselves a little bit of time, because as you say, if you're having to rely so heavily upon the manager's skill and the manager track record, typically there's some restrictions until the fund starts to establish its own specific following and track record within, particularly in certain wirehouse firms where they are a bit more conservative. We're seeing a lot of traction right now in two areas. Infrastructure is one that you mentioned, and with some of the recent federal bills that have been passed, and frankly the high level of inflation, it makes a lot of sense. There have been 8 infrastructure funds launched in the last 6 months that are just in this product wrapper alone. There are other infrastructure products being launched in the private fund space. And so a lot of capital is being deployed. And many times, climate action or impact is an element of what these larger infrastructure players are doing in the space. So firms like Brookfield, KKR, Apollo, they're all deploying billions of dollars right now of capital. And, infrastructure is a category that kind of goes in and out of thematic favor, if you will. But right now, much more so than real estate, just given some of the concerns about commercial real estate in the US, infrastructure has really galvanized a lot of support and attention. In addition to infrastructure, we're seeing a lot of investment into private equity, and typically later stage, although there are a few venture capital earlier stage firms raising capital in this registered fund space, and part of the way they're deploying capital is into secondaries, and I think that also partly has to do with some of the valuation shifts that we've seen subsequent to 2021 and 2022. So secondaries are very popular right now, and that capital is being deployed very broadly across different geographies and different sectors. So some of that is benefiting some of the sectors in terms of that we care about in terms of private capital.
Okay. So I just want to make sure we give it a little bit of concreteness for our listeners. So when we talk about infrastructure, are we talking about things within the IRA that's supporting, let's say, lithium mining to, let's say, battery factories, to battery recycling, reclaim, to even wind farms and so forth?
Yes.
Okay.
Yes, the funds that I'm referring to, there is one that is dedicated to sustainable forms of infrastructure. The others, though, very diverse portfolios. So they have elements of wind and solar alongside larger infrastructure projects, things like, bigger investments in airports or toll roads or things of that nature. So
Gotcha.
it's a combination of cleaner, green types of infrastructure alongside sort of basic infrastructure. But the firms like you know part of the challenge actually right now is they have raised so much capital, these infrastructure funds, that they're sitting on a lot of cash. And I actually think that's an opportunity for climate action because they're considering projects and investments that they may not have considered, a year ago, because they're looking, speed of deployment is still important. And you can't be sitting on $1 billion of cash if you're expecting to continue raising capital. And so that's actually, I think, a category of sort of good problems to have. But if they aren't able to successfully deploy the capital, it's going to result in lower returns for investors. And so that's why I think some of these infrastructure managers have a real opportunity right now to deploy capital more broadly, perhaps, than they used to.
Yeah, that's interesting. And certainly, if you look at the kind of macros, I'm sure that some of them are buying their time because there is going to be expected further deterioration in price, whether it's private valuation or public valuation, but certainly we're talking about private for the most part. So there's definitely that opportunity. Now, I want to say that there's also the geopolitical aspects as well, right? So the fact that we're trying to protect our electric vehicles, for instance, manufactured here, and all the supply chain that goes into batteries, and be able to do it onshore versus having to depend on China, for instance, or even semiconductor and the protection of some of these critical infrastructure plays, as well as expanding out plants, whether it's Samsung or others that are more locally based out of the US, for instance. Can you talk about that and why and how does that even play out or intersect at all with climate change?
Well, I think it does, and as more federal and state investment is being put into bringing onshoring some of these capabilities, we're going to see the investment product sort of arena catch up to where the need to deploy capital. I would say that there's a little bit of overhang from commercial real estate, but the specialty real estate investors, these are the types of opportunities where they're looking to grow their portfolio of real estate investments. You also mentioned farmland agriculture, and we're also seeing, the best farmland in the world is here in America, and so being more efficient with the use of our resources, including water, which is mission critical for farmers and for agriculture. There's a lot of tech application, not just in the farming process, but also in the supply chain. And that's farmland and agriculture technology and investment is an area where we've studied very closely what's going on because, not only are we're needing to feed the US, we're exporting a lot of food and we're helping feed beyond our borders. And so, water is a limited natural resource. There have been some interesting investment products around the water theme, but it ties back to this food or this farmland and agriculture theme too. So we are seeing a lot of smart farms and also in the real estate connection is storage, cold storage
Mm.
being built specifically for product going to market. So it's amazing because you kind of think of, you know, Iowa and cornfields, but the farmland business has been embraced the use of technology on the front end. You know, when you're trying to buy a property and you're trying to understand the water rights in that area, also the use of technology in the process of farming to be more efficient and to grow crops that that buyers actually want. So it's amazing how I think that the investment side of things maybe has to catch up with the actual need, but we are starting to see that more and more.
Yeah, I really appreciate you bringing this up because agriculture has been very complex to say the least. I think over the last 10, 15 years, while we've seen pockets of innovation and adoption for the most part, but because of COVID and some of the supply chain challenges we've had, and then, of course, extreme climate change that's having impacts around yield, and just pragmatically, farmers are aging and they don't have younger people, not to mention labor has always been an issue. So whether they've wanted to invest in additional capex or not, they're at a point where they need to scale out, not just in terms of robotics and automation, but to your point, infrastructure things. And again, this is part of the reason why we saw a spike in cocoa from Africa, for instance. So it makes plenty of sense. And I think that as much as we talk about vertical indoor farming, the reality is soil-based farming is here to stay, so we need to make sure that there's efficiency around this. I want to transition for the remainder of the time to talk about your consulting services because while you guys have your own products like the XAI Octagon floating rate and alternative trust, as well as a couple others, really you guys are focused on helping alternative asset managers to launch their own registered funds. How do you guys help with some of the product design, structuring these assessments and giving them advice, as well as even private label some of these things once it gets listed into the secondary market, and how do you support them?
We do. I mean, there's really a lot of attention right now on the US wealth management channel. You know, McKinsey and Bain talk about the rapid growth and the rise of the retail investor with the decline in defined benefit programs. And so now you have private fund managers, even private equity venture capital firms who are saying, well, we need to diversify our revenue base and move into the retail marketplace. But the only way to do it is with a registered fund product that can be sold to individual investors because the SEC is very protective of how, you know, we sell products. Sadly, because of bad behavior in the 20s and 30s, as you know, before the Great Depression. And so there are a lot of good protections in place, but with private markets capabilities, these are complex products. And if you are running a private credit shop and all you have are private funds being sold to institutions, you don't know the first thing about being 40 Act compliant or being SEC registered. And so our consulting practice actually grew out of the work that we do with asset managers. As we were talking with them about this growing market opportunity, many of them said, well, that's terrific, but you know, how do I build one? And so we partner with asset managers who, some of them, you know, just want to sub-advise, which means partnering with a larger asset manager. Some, though, want to kind of control their own fate and want to have a product with their own brand name on it, because this is a long-term trend, you know, that's just now really getting started in the last 3 or 4 years. So firms like Blackstone understand this opportunity. Other alternative market leaders like KKR, Apollo, you name it. And so those alternative market leaders understand that they need a footprint in the retail marketplace, but there's many other alternative firms that don't have the resources of a Blackstone or the same sort of sales force. So that's where we step in and we can help these asset managers cut through a lot of complexity and hopefully save people a lot of time.
Yeah, makes perfect sense. And certainly even within the venture capital space, the last couple of years, I would say, you know, companies like Sequoia have recognized that they need to change their fund structure altogether and have even chosen to become registered investment advisors and have evergreen funds and open those up to non-accredited through exactly the kinds of structured products that we're talking about here. For the remaining time that we have, I want to ask you as president of XAI, what are some of the priorities for you? And also, what's the, in terms of the goal of increasing your presence in the interval fund marketplace, what does that mean and how do you plan to proceed with that?
Well, we have been educating advisors and investors on alternative investments now for about 8 years. And it's really just been recently that this category has grown very popular. So it's nice that it's finally getting some media traction. We do have a lot of great relationships with reporters who are covering the space and trying to spread the word. And with that, we're often talking with asset managers and financial advisors about the benefit of alternatives for their own practices. And, in America, most of wealthy Americans are working with a financial advisor or working with a financial planner. And, if you're making investment decisions, it's helpful to have someone who understands alternative investments. And so we do spend a lot of our time working with financial advisors. And for them, alternative investments, it's like tax planning was, or estate planning. It's another service that they can provide. And our view is that too many Americans are over allocated to US equities, that there's not the global exposure that they should have in their traditional stock and bond portfolios. And nonetheless, they also don't have much in the way of private markets access. So we're very, very laser focused on educating members of the interval fund ecosystem. And it really does start with the financial advisor and then goes from there.
Excellent point. And more of a commentary, just to kind of wrap up here, is that I think one of the biggest things that's affecting everyone from institutional all the way down to retail investors is this imminent risk, catastrophic risk of the US dollar and US debt, and what that means not only for treasuries, but even the broader stock market. So the importance of diversifying across to these alternative categories is so critical to making sure that regardless of some of these macros that can have adverse long-term effect, investors of all types can actually start to mitigate and potentially even take advantage of these opportunities. So with that, I have been joined by Kim Flynn, Managing Director and Partner at XA Investments. Thanks for joining.
Thank you.
If you've enjoyed this episode, take a moment to rate our show on any podcast platform that you listen to. Scroll down to the bottom and push 5 stars. It's that easy. And as always, thanks for listening.